Hey there, great people. Thanks so much for dialing in. Touching base to let you know that as with all of our content, this is general in nature. It does not take into account your specific or personal circumstances nor your individual risk profile, and as such should not be acted on accordingly. If you get value from this and you want to explore some things further, I strongly recommend that you get personal advice from a qualified professional.
What separates great investors from the rest? Is it strategy, is it timing, or is it something else? In this episode, we sit down with Roger Montgomery, one of Australia's top minds in investing, to uncover his key lessons from the last 30 plus years in investment markets. From his best investment advice from mentors to what he sees for 2025 and beyond. This is a must listen for anyone wanting to build their financial knowledge and help them give confidence to pull the trigger on investing. So we're very lucky to have Roger Montgomery, chairman and founder of Montgomery Investment Management. So Roger founded Montgomery Investment Management in 2010, and Montgomery is an Australian boutique investment manager which offers investors exclusive access to a range of managed funds, including domestic and global equities, as well as private credit funds here in Australia. Roger has over 3 decades in investment markets, including funds management, equities analysis, and credit markets. Roger's also the author of the best-selling book Value.able. This book is a guidebook on the how-to for stock market investing. Also, Roger appears regularly across a string of platforms, ABC Nightline, podcasts and TV, and the Australian and Ausbiz. Roger, I appreciate you taking the time and dialing in with us.
Oh, it's great to be with you, John. Thanks for having me on the show.
Thank you very much. So, Roger, I'm hoping just to go right back to the beginning and just get some understanding of your origin story. What inspired you to take a keen interest in investing and even kick off Montgomery Investment Management?
I was given a book by a friend on one of my early, when I was in my 20s. I was given a book about Warren Buffett, and I'd started working as an equities analyst in Melbourne, and then moved to Bankers Trust here in Sydney, and was working in Treasury and trading derivatives. And I remember just that fast pace, futures trading and derivative trading and proprietary trading. It was full on, and I wondered whether there was a calmer way to do well. And then it just so happened around the same time that a friend gave me a book about Warren Buffett for my birthday. And I thought, you know what, this looks like it's got the ingredients of what you need.
Yeah, great. And what was the book called, Roger?
It was called The Warren Buffett Way. I think I have it on the shelf back here somewhere. Oh, yeah. I won't look for it now, but yeah, it's sitting there somewhere full of notes. I always read with a pen, and I make notes as I read.
Yes, fantastic. Good way to embed learnings. And so you've been in the industry for about 3 decades now.
Bit more,
A bit more. We'll round it down to 3. What's the biggest shift in investing from when you started till now, do you see or think?
I think the faddish cycles, so the thematic fads, they seem to cycle much faster now. Everything happens more quickly than in the past. And that's what I've noticed. So, for example, the AI boom, is an example of that. That accelerated much more quickly than, for example, the autonomous vehicle boom and the internet boom before that. Those rallies took years. They always fall in a heap very quickly, but they took years to develop. And now these things, the AI one didn't take years, and happened within 12 months. And so I just think the cycle, those thematic cycles, when they occur, and you can see them happening, they're not always based on sound reasoning. Maybe at the start they were, but then everyone just piles on. And I think because the population's bigger, it's just a virtue of the function of the fact that the world has more people in it. You see these things move much more quickly.
Bit of a compounding effect, yes, for sure.
Yeah.
And going back to the early days of your career, is there any one thing you would do differently when it comes to setting your career up or investing?
I think not sell the things I'd bought. Someone once said to me, you you become rich buying and selling, but you become wealthy buying and holding. And I think, I think about the things that I owned and sold and that are worth much, much more today. So, that would be the one lesson I think for younger investors to abide by. If you've done all the work and all the research and you've found a great asset, you've bought it, try not to sell it.
Great advice, actually. And what would you say in terms of mentors who's had the biggest influence on your career and investment philosophy?
I think that's Charlie Munger. I met Charlie before he passed away some years ago in Pasadena in California, and I used to attend his annual general meetings. And I didn't go to the Berkshire Hathaway meetings, but went to the Charlie Munger convention. We call it the fan club. And I think he was a very, very wise investor and a genuine thinker. So I got a lot from him.
A bit of a sense of humour too. I actually went to the Berkshire Hathaway AGM in 2015, and he made me giggle a few times for an older bloke. So
yeah. No, he at the end of his annual general meetings, he would sit on stage, and people would bring books up for him to sign or get a photo with him and whatever. And I remember I think I took 11 books up, and he signed every single one of them. And as I left, I heard him say to his assistant, 1 book per person from now on.
Probably time management thing. So
yeah, exactly.
And just back, have you ever had that one golden nugget in terms of a piece of advice that you've received, and how's it helped shape your philosophies or the way you invest?
Stick to quality. That's it makes life a lot easier afterwards. And the other thing I would say, and this is, I know you only asked for one, but if I think about, insights or learnings that might help other people, it is that, it is that idea that that really booms begin with just a few people and at the depths of despondency.
Yeah.
That's where you'll really, when everyone else is running around with their heads cut off, when everybody thinks that the world is ending and markets are never going to recover, when they're really on their knees, just be aggressive, because, as sure as day follows night, markets will be booming again at some point. And if you can be patient and wait for them to recover, you'll do very well when you buy in the deepest, darkest moments.
I certainly remember that. It's really good advice, Roger. I remember coming out of uni and it was right at the GFC. And I remember CBA stock dropping to $20-something a share in a click of her fingers, and CSL shares at 35. And my big regret is I didn't get enough holdings there. So it's never enough.
I can one up you on that. I can remember in the early 90s when Westpac was trading below $2 a share.
Oh, there you go. Yeah.
And I remember calling my mum, and I said to mum at the time, You'll never be able to buy a bank for less than $2 ever again, Mum. You've got to buy some shares in the banks. And fortunately, she did.
Oh, good on your mum in Montgomery. That's good. So, and any lessons you've learnt the hard way that you'd pass on to others from experience?
Same as before, selling things too early.
Yeah.
Selling quality. If you own something that's very high quality, sure, it's going to be volatile. When the market drops, even quality businesses, their shares are going to fall as well. And it's very, very hard to ignore that. But if you can say, you know what, it's going to drop 50%, it's just going to drop 60%. But rather than sell, I'm going to add, I'm going to buy some more, you'll do okay. In fact, you'll do much better than okay.
Yeah, great. And so many of our listeners and customers are in their sort of 30s and 40s, Roger. So they're just sort of really getting into that wealth creation, the early phases. What are some of the biggest mistakes you see young investors make?
Thinking they know it all. That's probably the one. Thinking that they're the first ones to have experienced this. It's all happened before. Generation after generation after generation make the same mistakes. People are always looking for an easy path. They're always looking for the the short way, the quick way. And I remember seeing young doctors and dentists who thought, hey, look, my expertise is in medicine, and it's taken me, almost 12 years to get to this point. But when it comes to investing, I can read one book and I'll be a genius at it. People are always looking for shortcuts and not realizing that it takes time to become good at anything. And you really do have to have some battle scars to become a better investor.
I like that, battle scars. So basically stick to your knitting and
stay within your circle of competence. And if something, ask yourself quite honestly, or answer this question quite honestly: am I an expert in this field? Am I bringing expertise or an edge that nobody else has to this particular field? And if you are, then you'll do well at it, and the money will come. But if you don't have an edge, admit it, and let someone else who does have an edge do it for you.
Get someone in your corner. And this might be good advice for your own kids, because I believe they're roughly in my age bracket. But if we just took you back to being 30 again and you're starting to build your wealth, how would you approach your investing?
I do exactly what I've done, and that is focus on really high quality businesses. Be patient. Wait for them to be really, really cheap. Sitting around twiddling your thumbs for 2 years is quite boring, and you think, these things are going up and I'm missing out. But the simplest thing to do is just to wait, and wait for that thing to become good value, or it doesn't have to be. It doesn't have to go down in price. But if you've identified something that's growing quickly, then don't be tentative about it.
Yeah.
You don't want to bet the whole farm on it, but at the same time, you don't want to put an insignificant amount in that's not going to make a difference.
Yeah, absolutely. We always want to be moving the needle and not spraying and praying, I often say. So, I find there's just so much noise out there, and everyone's got an opinion with what to do with money. And my views is actually not one way to be right. So how can a early stage investor filter through that noise, cut through it? And, what sort of reliable insights are out there, do you find, Roger, for people?
I think you turn the market off. Just turn it off. Focus on. There's two ways to approach. I think there's two ways to approach the stock market in the first instance. One is to think of the stock market as a venue for betting on the ups and downs. Gambling on red and gambling on black, betting on black or red at the roulette wheel.
Yeah.
And I'm just going to bet on things that go up, and I'm going to avoid the things that goes down. Well, that's treating the stock market like a casino. The other approach is to say that the stock market is a venue where you can buy pieces of extraordinary businesses. If you look at the used to be the BRW Rich 200, it's now the Australian Financial Review Rich 200.
Yeah.
And the Australian has a Rich 250, I think. But if you look at those, no one in there became extraordinarily wealthy by saving. It was by running businesses, by running a business or owning a business, or investing in businesses or property and so forth. And the stock market is a venue where you can tap in to that extraordinary wealth creation process, where you can buy pieces of businesses. So rather than treat the stock market like a casino where you bet on the ups and downs, turn it off, look for great businesses, outstanding businesses. And if a business can generate a high rate of return on its capital, and as well as that, retain a large portion of that profit and generate another high return on the growing capital, well, that's the same as a bank account that has $1 million in it, earning 5% today, but when it gets 10 million, it earns 10%. When it gets 20 million, it earns 20%. When it gets 50 million, it earns 50%. That's the first prize in investing. And great businesses, extraordinary businesses by definition, are able to do that. They're able to grow their return on equity and their profitability. As they get bigger, they become more profitable. And they're the businesses you want. And they're easy to find. There's plenty of them out there.
Yeah, keep stacking the blocks. And I love that gaming analogy. I saw this graphic, the probability of getting a positive returns. This was on the S&P 500 index. And if you invest for one day, it's about a 50-50. So you may as well be at the roulette table.
Yeah.
And if we extend that out over 10 years, it's in the high 90s, your probability. So absolutely, that's fantastic, Roger. And yeah, absolutely, you can't shrink yourself wealthy. You need some growth. So
Yeah, indeed.
and just around your views for, 2025 and beyond, there's heaps going on with Donald Trump and deep seeks and tariffs and all these sort of things happening. How do you see market shaping up for 2025? And what are the key themes or even risks investors should be aware of in your eyes, Roger?
Well, look, everyone here has been quite bullish since 2022. And that was despite the fact that, there was a lot of commentary that we're going to have a recession. A recession was around the corner and you need to be conservative. As long as you have, since the 1970s, if you have a combination of positive economic growth, even if it's anemic, as long as the economy is growing and you have disinflation, in other words, consecutive prints of inflation that are lower. So it's not deflation. Deflation is lower prices. Prices are still going up, but they're going up at a slower rate. And that combined with positive economic growth tends to be a positive setup for stocks, particularly innovative companies with pricing power. So, and that without exception, whenever you've had the combination of those two things, innovative companies with pricing power have done well. Now, I think that backdrop has been in place since 2022, and I think 2025 it will be in place as well. So the backdrop is generally positive. The difference between 2022 and today is prices are higher. PEs have expanded, price to earnings multiples have expanded. So that makes them a little bit more vulnerable to disappointment. In other words, this year we could have a little bit more volatility, but generally 2025 should be positive. Looking further out, the risk, you asked about risks. Markets boom when there's ample liquidity in the financial system. And the US central bank, the US Federal Reserve, has surreptitiously injected about $6 trillion of liquidity into markets. And it's done that. That's about 15% of its total liquidity. And that's helped Bitcoin boom, the AI boom, the stock market boom. Everything's gone up because of that extra liquidity. Now, here's the interesting thing. A lot of money, about $70 trillion, was borrowed globally when interest rates were zero during COVID. And the average term of those loans is 5 to 7 years or 6 or 7 years. And that means that come 2026 and 2027, that debt needs to be refinanced. It doesn't mean the stock market's going to crash, but it does mean that some of that liquidity that's been driving stock prices higher is going to be distracted. It's going to be redirected to fund the refinancing of that debt. And so there could be a bit more volatility in late 25, 26 and 27. But I think most of this year will be quite positive. You've had a lot of disturbing stuff happen. We just saw the Trump tariffs, for example, and the market dropped 2%, and then it bounced again. It didn't bounce all the way back up, but it bounced, and the market's not plunging. So even amid bad news, the market's remaining reasonably supported because liquidity is still pretty good. So I think disinflation, positive economic growth, reasonable liquidity at the moment. We'll have a positive year in 2025, maybe not as strong as last year, 2024, but still a positive year.
Yeah, fantastic. And just on that sort of that liquidity and profits maybe being a little bit more challenging, but still expecting some growth. Are there any specific industries or certain trends you keep an eye on?
Not really. We're really bottom up. We're really looking from at the business level at each company and its prospects. So I wouldn't say there was a theme other than communications. I think communication will continue to be a strong one. And I also believe that data centers are a great asset. Even as a REIT, as a real estate investment trust, data centers are going to be in demand. There's a little bit of a tension there between, a lot of investors think that there's going to be an oversupply of data centers because so many are being built, and that will put pressure on prices. But what you have to understand is that demand for bandwidth, demand for storage, demand for what we call, data processing
Mhm.
That's going to be it's going to be a much higher than we can even imagine because of the amount of processing and the particularly with AI powered tools. Your computer is going to be talking to the cloud far more frequently per second than it ever has before, and that's going to overwhelm supply, at least in the short term.
That's the physical side of this AI boom for sure, and that's great. And I've heard you talk like around sort of the mid to small cap sector. Is that something that you're particularly interested in, or is it a muchness?
No, yes, because what happened is when markets bottomed in 2022. Can I just take a step back and just explain something to investors that I think is really powerful? PE ratios, price to earnings ratios, what they do is they reflect the popularity of the stock market.
Yep.
So when the market's popular, when everyone wants to invest and everyone's really excited and feels safe, PEs expand. So if you've got a company with $1 of earnings, the PE will be 30 times that $1 of earnings. But when the market's on its knees and depressed, it might just be 15 times or 20 times or 18 times. Now, in late 2022, PEs for small caps were at historic lows.
Mm-hmm.
In fact, in 2022, you could go back quarter of a century and only find that in the GFC were PEs lower than where they were at the end of 2022. Now, here's the interesting thing. If you buy a stock on a PE of, let's say, 12 or 13 times, it doesn't matter what the PE is, but if you sell it in 5 years' time on the same PE, in other words, the stock market never became more popular. It stayed depressed. But you buy a company whose earnings grows at, let's say, 15% per annum. So if you buy a stock on a PE of 12, sell it on a PE of 12, and in between, the earnings have grown by 15%, well, your internal rate of return is going to be 15% per annum. In other words, you're going to make 15% per annum. You're going to double your money in 5 years. So back in 2022, we could see that PEs were low, that all we needed to do was invest in companies whose earnings were growing at double-digit rates, and our returns would be double-digit, even if the stock market didn't become popular again.
Yep.
But of course, what's happened since then is the stock market has become a bit popular. But here's the answer to your question. Big caps have become more popular than small caps. Small caps are a little bit more popular, but they haven't become as popular as big caps. And so there's a gap there that is quite wide. And so that's why we've preferred small caps over big caps over the last year or so. And they've caught up a little bit, but there's still more to go.
Still a bit of upside. Yep. Great history there, an example of why small caps might be valuable. And just talk again back in terms of economy, both globally and in Australia, what do you think the outlook more so here is really, and how should investors position themselves, do you feel?
Actually, don't think it matters.
Doesn't matter.
Doesn't matter. And I'll tell you why I think that. I know that might run contra to the views of other guests you've had on the program. There's actually no correlation over a 12-month period between economic performance and the stock market. None at all. Mm-hmm. There are times, 50% of the time if the economy is growing, 50% of the time the market's up, 50% of the time the market's down. There's no relationship there. What matters is microeconomics, not macroeconomics. So what matters is individual industries and the competitive landscape within those industries. That's what matters. And to the extent that the broader economy might influence an individual industry, well, that will have an effect on a business. But in terms of stock market performance and broader economy, there's not really a strong relationship there. So I would really, implore investors to think more about the economics of an individual business than worry about the big economy.
Yeah.
For the time being, I don't think we're not at risk of a recession. We've got strong employment. That will keep us out of recession. We had all those fears about the mortgage cliff, and I wrote a couple of pieces in the Australian saying it's a furphy. We're not going to have a mortgage cliff. We're going to have a gutter that we'll just step over while people remain employed. And let's remember that when it comes to mortgages, banks are much more considerate than they were in the past. During COVID, you might remember we had about 4 million people unemployed, or 4 million additional people unemployed, and people couldn't pay their mortgages. What did the banks do? Did they take possession of everyone's house and dump them on the market? Of course not. They gave everyone a holiday. They said, don't worry about paying back your mortgage. The interest will accrue. There's no urgency to pay us back. Don't worry about it. And so, I think if anyone's ever worried about 30, 40% corrections in property prices, they're barking up the wrong tree. Probably won't happen. Financial system couldn't cope with it. The banks couldn't cope with it. The RBA couldn't cope with it, and government would lose face. So there's no incentive to see that happen. From a broader economic perspective, I don't think we're going to have a recession. I don't think we're going to see property prices crash or anything like that.
Brilliant. Yes. And that's awesome. Just, stick to the fundamentals, get the bigger picture out of your mind and focus on those sort of microeconomic factors. And just another interesting one that's been coming up in topic, and I know you'll be all over in this AI space. You got this Chinese AI player potentially coming in the market, DeepSeek. And what does that mean for the big seven over there? And why did that make NVIDIA shares cop it in the neck so heavily over one trading session?
So the concern is that because China didn't have access to the latest NVIDIA chips, they used the old I think they were the H800 chips, or was it the H100? I can't remember. There's one that's more advanced than the other. They had the older chip. And in order to develop something, necessity is the mother of invention. They didn't have the latest chips. So they couldn't use brute force for inference. Inference is when your AI is doing what AI does, which is reads the instructions you've given it and then provides an answer. So in order to infer as quickly as the leading chatbots or the leading large language models, the Chinese developers were forced to be more efficient and turn on and turn off bits of the AI so that it just used the bits that it needed. And that meant it was more energy efficient, and it also meant it was more data efficient, or, in terms of the amount of data that it required and the amount of compute power that it needed. And so the disturbing thing for NVIDIA is that, hey, if the West starts to adopt this way of dealing with inference, then it won't need as many chips, it won't need as much power, it won't need as much storage. And so this boom in spending that perhaps was, the icing on the top of that was, or the icing on the cake of that was Trump announcing $500 billion spend on AI. Well, you might not need to spend that much money. So there might not be a need for so much hardware and so much bandwidth and so much storage and so much energy. That's why we saw some of the nuclear stocks drop as well. And so that's the disruption. And that's the other thing that investors should remember about technology. It's very, very hard to pick winners in new technology. And more often than not, history is replete with examples of new technology where the consumer was the winner, not the investors in the businesses. Whether it was the motor car, the invention of the motor car, when Carl Benz in the late 1800s drove the first Mercedes-Benz. If you had been there at the time, you might have said, gosh, this is going to be transformative. This is going to change the world. But what was interesting is that, in the United States, there's been about 1,500 car manufacturers since then. And none of them exist today that are profitable and weren't bailed out by either federal government or private equity. They've all gone broke at one point or another. So, and you might say, well, Tesla's the exception, and perhaps it is. But all the others have gone broke at one point. And so, new technology like that doesn't necessarily reward investors, but it does reward consumers. So you can be sure that consumers are going to benefit from AI. I just can't tell you who's going to win in terms of business.
If you knew that, we'd be sitting on a yacht probably, Roger. So that's fair and reasonable. That's great. So, thanks so much for the insights there. Just as a final couple of things, where can listeners learn more about you and Montgomery Investment Management?
So we have a blog at rogermontgomery.com. So it's my name, rogermontgomery.com. There's a blog there, and we post daily to that blog. And now we're in reporting season, so we'll be putting a lot of results up. but we also record videos and podcasts, and they're available through the blog as well. And then obviously if investors are interested in any of our funds, they'll go to you, John, and you'll be able to direct them.
Absolutely. And I'll get a link to the blog in the show notes for sure. I know I'm subscribed. And any last words for our listeners on their journey towards financial independence before we close
the key, it's harder for young people, but the key is patience.
Patience.
Sometimes doing nothing is the most profitable thing to do.
Brilliant. Thanks so much, Roger. Appreciate
it's a pleasure,
your time.
John. Great to talk with you.
Yeah, we'll keep in touch.
Okay. All the best.